First of all, I would like to thank the organizers for giving me the opportunity to present our paper. It's a joint paper with Andrei Vernikov, and in this paper we try to exploit the advantages of having a very detailed statistics that Russian banks disclose in their balance sheets and profit and loss accounts. Particularly, we try to look deeper into the cost structure of Russian banks and to understand what do we call cost efficiency, how do we estimate it. And we try to incorporate some new sort of cost efficiency definition into the stochastic frontier analysis to re-estimate the bank ownership cost efficiency relationships. And also, because we have a very long time panel dimension, we try to introduce some bank level heterogeneity in this relationship. We have a very vast literature on comparative bank efficiency, and just to name a few, and very contributed studies by Bonin, Hassan, Wachel 2005, Karas, Hurs and Weil 2010, and so on. Well, some sort of conventional wisdom from this literature is that first, foreign-owned banks are the best performers, always. But we have at least two papers that claim the opposite. Mian 2006 in Journal of Finance theoretically prove that there could be some other outcomes for foreign-owned banks. And Lansing and others find some empirical proof for that. Well, the second conventional wisdom is that state-owned banks land behind in terms of efficiency that we have already discussed here today. But again, it's not true. For example, for Germany, for Russia, as they, there's a lot of reasons, but one of them is that they develop a bank-based financial system rather than financial-based. Well, previous studies on banking in emerging markets in transition have missed some distorting effects because bank scope does not provide the structure of costs. Previous studies could not look deeper into this structure of costs. But as I said, we have very detailed statistics on Russian banks, and analyzing them, we found that there is a, well, just because you have a lot of assets and liabilities denominated in foreign currency, taking into account that Russian ruble is very unstable currency, it causes very dramatic revaluations of assets and liabilities denominated in foreign currency, and the share of negative revaluations. Let me refer it revals. The share of negative revals in total costs might achieve up to 80% of all costs. Well, there is a large differences between different banks. I'll show it later. But we suppose that these revals are something that outside the managerial control. So we should exclude it because they are caused by the instability of exchange rate dynamics, not by managerial efficiency or inefficiency. So we should try to exclude these revals and try to re-estimate traditional bank ownership cost efficiency relationships. So this is exactly will be our first contribution to the literature. And the second one, in previous literature, authors usually introduce only dummies for different bank ownership, state ownership, foreign ownership, and the resulting estimates provide us a sort of average ranking during some period of time. Well, if this period of time is quite small, it's okay, but if we have a very large time dimension of our panel, there can be some different movements, and we should account for them. Just to do that, we try to incorporate some bank level heterogeneity in bank ownership cost efficiency relationship. Well, I've just said that, and moreover, we use a refined classification of state banks. We split the group of state banks into two parts. The core state-controlled banks, it consists of three banks, Sberbank, VTB, and Rosselshausbank, and all the other state-controlled banks. We do that just because loans that are granted by these banks may be of political reasons, and loans provided by these banks might be of more market-based reasons. And also we use a refined definition of foreign banks. Well, we focus only on those banks controlled by foreign strategic investors as opposite to portfolio investors. And we filter out the pseudo-foreign banks, those ultimately controlled by Russian capital, for example, Pромsвязьбанk. Well, so we would like to see how revaluations of assets and liabilities denominated in foreign currency affect bank ownership cost efficiency relationship. So for these reasons, we will exclude these revals from total costs and re-estimate the relationship. But how to do that? The literature proposes us two empirical strategies, the so-called two-step or two-stage approaches versus one-step or one-stage approaches. Well, two-stage approach is when at first stage you estimate, you specify transfer cost function, you aggregate some efficiency scores, and at the second stage you'll try to estimate the determinants of efficiency scores. This approach was realized in Maudos, Fernandez de Guevara, 2007, Solis Maudos, Berger, Hassan Zhu, and so on. But there is a sort of underlying problem inside of this two-stage approach. Wang and Schmidt, 2002, show that as at stage one, efficiency scores are supposed to be one-sided, but at stage two, they are two-sided variables in this approach. It might result in bias. So Batiz and Coeli in 1995 propose a one-stage approach for stochastic frontier analysis. They essentially estimate both stages simultaneously at one step, just to deal with this problem. So this one-stage approach, we can see it in Bonin Hassan Watchell paper and Karas paper and so on. But we choose two-stage approach for our basic estimation and one-stage alternative for robustness checks. Why? Well, Russian banks are very different in terms of market power. There is a vast literature on market power efficiency relationships. All these papers introduce some different hypotheses regarding these relationships. But if we want to estimate price market power, something like Lerner index, we should estimate marginal costs. So we should do it in the first stage automatically, and then come to the second stage. So we just would like to take this literature into account, and that's why we use a two-stage approach. So just to outline our empirical strategy. So we specify transfer cost function. We take as a dependent variable operating costs, total costs minus interests, expenses, and with two alternatives, with revals kept and with revals dropped, negative revals kept and negative revals dropped. We use three input prices, three outputs, commercial loans, deposits, and fee and commission, and one net put, equity capital. And then we aggregate bank level SFA scores into group level for state one banks, national champions, Sberbank, VTB, and Rosselshausbank, state two banks, foreign banks, and private. Then we try to explain group rankings changes in terms of SFA scores in this static panel framework. Well, actually, previous research at second stage tried to estimate how these dummy variables for different groups affect SFA scores? Well, as I said earlier, as we have a very large time dimension of our panel, we cannot longer suppose that these effects will be stable over time. So that's why we try to multiply these dummies by some bank-specific variables to introduce bank-level heterogeneity in these relationships. So just to start with something, we, as a candidate for X, IT, there could be a lot of candidates, but just to start with, we take such a general characteristic such as equity to assets ratio as a proxy for risk preferences, or loans to assets ratios as a proxy for asset composition. Then we estimate this using two-step GMM to address some endogeneity, heteroscedasticity concerns, and so on. And then we try to estimate, based on these equations, what we call distant functions. For each group J, we try to estimate how the average ranking changes depending on risk preferences or asset composition variations through the time. So I'll skip on this slide. Well, we combine several sources to reach a very, very large panel data set. We use monthly balance sheets on Russian banks, quarterly profit and loss accounts. Macroeconomic controls are obtained from Federal State Statistics Service. Time period is from 2005 to 2013 in quarterly format. And the number of banks, depending on the quarter, from 700 to 1,000, and it results in 20,000 to 20,009 bank quarter observations. So here I just show the time evolution of the distribution of negative revals in total costs. So you see that some banks might have lower zero ratio, but some of them might have up to 76%. It's just revaluations. It's not something that inside the managerial controls within the costs. Well, average level is from 13 to 35. And so it's quite a huge variation, and of course if we exclude these revaluations from total cost and re-estimate translocus cost function, it results in some new, it should result in some new empirical findings. Well, one interesting picture that arises from here is that during the crisis we see a very, very strong increase in these shares for all banks. So of course, it will affect our estimation result if we do not exclude revals. We will see that during the crisis, banks suffer from decreasing cost efficiency. But we know that during the crisis, banks often cut expenses, personal expenses, and some other additional expenses, and efficiency scores must be higher during the crisis. Well, the composition of our sample, as I said earlier, we have a state 1 dummy, the core state-controlled banks, so national champions. These are 3 banks, Sberbank, VTB, and Rossельхозbank, with growing shares in total assets from 37% to almost 43%. Other state-controlled banks from 28 to 46, with growing share in total assets, in total banking system assets as well. Well, we have a lot of privately owned domestic banks. Their share in total banking system assets is declining over time, and which is very important that the number of foreign-owned banks might rise, but their share is very, very small. Only 8%. So, just statistics. Well, when we estimated our translocus cost function in both alternatives, we saw that the effects of revaluations are really very significant. So this is the average distribution with revals kept, and with the revals dropped, this one. So the effect is very strong. If we look on time evolution of group level SFA scores with revals kept and with revals dropped, we'll find a lot of new stuff. First of all, on average, Russian banking system might be not so inefficient, about 70 to 80% of cost efficiency scores. Then we see indeed that during the crisis, if we keep revals, during the crisis efficiency goes down, but if we drop them, it goes up. Second or third, we see that the ranking of banks really changes over time. So here we see that state 2 banks were the most cost-efficient banks. Here, state 1 banks become more cost-efficient. So we need to model these changes in time evolution of rankings. Also, what is really interesting that despite of very large time dimension of our panel, the cost efficiency of private-owned banks is quite stable, about 80%. Well, as I show you, this group is constituted by approximately 800 or 900 banks. Of course, there is a lot of different, very different banks inside of this group, and maybe it's for the future research. We can try to find out some subgroups within this group and estimate differences between them. So, of course, we have a lot of inefficient private-owned banks and very, very efficient maybe large private banks. It's for the future. And the last, that foreign-owned banks, despite of the classification, appears to be the least significant, the least cost-efficient players. Well, first of all, as I said, their share is very, very small, so they could not, by some reasons, enter the Russian banking market, or they withdrawn from the market by some reasons. And the second point for foreign banks, when I look deeper into these SFA scores, into the SFA scores of foreign banks, I found that for those foreign banks that have a long history of operation inside the Russian banking system, for example, UniCredit Bank, Raiffeisen Bank, some other banks, they have a very, very high SFA scores, about 95%, like Sberbank has. But it's about 1/3 of these banks, these very efficient foreign banks, are about 1/3 of all groups. The remaining part of the group is new foreign banks that might enter the Russian banking market just before the crisis, and they quickly become unprofitable. And they withdrawn their licenses in 2009, 2010. So what we could do, we could just make two subgroups of foreign banks, control group and treatment group, and provide some difference in difference estimations to see difference between them. So regarding my our so-called distance functions, and introducing bank level heterogeneity into bank ownership cost efficiency relationship, I would say that I'll skip that slide. Well, when we introduce equity to assets ratio as a factor determining the heterogeneity of bank ownership cost efficiency relationship, we see the following picture. Well, we see that when state-owned banks gradually increase their equity to assets ratio from their own distribution, from let's say 9% to 21% equity to assets ratio, their cost efficiency tend to rise. And for example, this figure means that a state-owned bank with equity to assets ratios equal to 21% is about 7 percentage points. He has SFA scores 7 percentage points higher than average private-owned banks. It's a reference group here. And we see almost the same picture for the foreign-owned banks. Moreover, we see that foreign-owned banks with large equities may become almost the most cost-efficient group in our banking system. Well, if we see at the same picture for loans to assets ratio, we see some other very interesting results. Here we have loans to assets ratio distributions for every group. And we see that when state-owned banks, national champions, when they decrease their loans to assets ratio from 19th percentile, let's say, to 10th percentile, their difference from average cost efficiency score of private-owned banks becomes much more higher. So the efficiency of national champions tend to increase when these banks decrease lending. Why? Because as we discussed here earlier, they might have a lot of political loans. And the opposite picture holds for foreign banks. When they increase their loans to assets ratio, their efficiency tends to increase, and they might become the most cost-efficient group. So, for example, some foreign bank with this equity to assets ratio is much more cost efficient than other groups. Well, okay. Just to outline, we have a lot of robustness check. We re-estimate our equations. We re-specified our translog cost function within the intermediation approach instead of production approach by adding more outputs, securities, foreign assets, and so on, and by estimating total costs rather than operating costs, and by accounting for panel fixed effects, the one-stage approach. And also we estimated our distance functions using Tobit estimation technique to account for censored nature of SFA scores. They have a lower and upper bounds, as we know. And in all these new specifications, our main outcomes remain qualitatively unchanged. I'll skip on this slide here, just show that within one-stage and two-stage approach, we have qualitatively the same effects. Now, the conclusions. So in this paper, we show the materiality of revaluations, and that they do affect our cost efficiency estimations, that they do affect bank ownership cost efficiency relationship. We control for that, and we show that the core state banks tend to be most efficient group in case they hold larger equity capital and decrease loans to assets ratio, while foreign subsidiary banks can outperform other groups in terms of cost efficiency only when they substantially increase lending. And if we would keep revals, the findings would be the opposite. So, thank you. And
Discussant is Vladimir Sokolov. You're welcome. В кармашек.
Ага. Кликер. А где кликер? А, вот кликер. Вот кликер, да. Вот это не кликер, а вот кликер. Okay, thank you for being paying attention for such a long time. We just have one more paper. I think it will be nice. Yeah, I have a discussion on this paper called Bank Ownership and Cost Efficiently in Russia Revisited, which the title concisely describes the content of the paper. And I should mention it's a very elaborate work. It has a lot of things done. Authors did a lot of things in terms of the careful literature review, many different specifications tested, variables, time periods, everything is explained in quite detail. So it's a big amount of work, I can say. In my presentation, my discussion, I will focus just on the main contributions of the paper, the way I see them, and I think as the way authors stress, even though maybe the conclusions are a bit muted by other things, I think, and I think you should focus more on some just main key contributions. Basically, authors utilize pretty rich bank level data, monthly data of all Russian banks' accounts, and quarterly data on all Russian thousands, about 1,000 Russian banks' income statements. They group banks into 4 categories: 2 types of state banks, and 1 foreign group, and 1 private non-state-owned banks. And they describe why this refinement is important and all that. And then basically they have 2 main results, I think, in this paper. One is that is kind of refinement in the literature that estimates the efficiency scores of banks by just paying attention to one additional variable, which is particularly relevant maybe for emerging market economies, where banks have a lot of assets or liabilities in terms of foreign currency, and then they have to do revaluation of those following big currency movements. So authors spend some time on describing what the revaluation is, and I don't know about other countries, but in Russia that particular item is on the income statement. So income statement, it's in the paper of the authors, but basically it would be all sources of income, then all costs, and then at the end it would be net interest margin, and then there would be a line adjustment for currency revaluation. That's the variable that the authors use. I'll spend more about it a bit later. And then second main contribution is that when they, after they construct the efficiency scores using the traditional methods and methods which drops this revaluation variable, they evaluate how efficient are those 4 groups of banks. And very sort of strong finding is that foreign banks are less efficient. And as the author explained, that most literature actually finds it the other way around, but then a few studies find the same result, which kind of, it's a big statement, so it's quite draws the attention. I should mention that this result holds with or without revaluation variable included into the specification. So basically these findings are kind of parallel. So they're not really, I mean, not the findings, the contributions, they're not connected. So one is kind of the refinement to the efficiency score calculations, and another is that in Russia foreign banks are less efficient. So these are the findings. Yeah, in my opinion, you spent a lot of time on literature, the data, and the techniques of this efficiency score calculation technique, and then later on multiple robustness checks. But then the key variable you introduce into this picture, you don't define very well. You just say, oh, we have this revaluation variable. But to me, it was first a little bit confusing what exactly that revaluation is. And I think you should maybe in the text define it a bit better. So I just spent some time looking at the central bank's description of the banking reporting. And basically, revaluation is the difference of the ruble equivalent of the foreign currency denominated assets or liabilities between the date assets liabilities were assumed and the accounting date. And on both of these dates, the ruble equivalent of foreign assets and liabilities calculated using the current official exchange rate. Basically, if I'm a bank and today I buy or assume some assets or liabilities in US dollars, because all Russian accounting is in rubles, I will use today's official foreign exchange rate to put it on my book. But then when I construct and report the income statement on the official date, there will be another exchange rate, and I will calculate accordingly, and that will be revaluation. Or revaluation could even occur between different accounting reports, right? So I maintain the stock of assets and liabilities in foreign currency, and then every time I just readjust its ruble value between quarterly income statements based on the current official exchange rate. And basically, negative revaluation. You see, revaluation in the income statement is just one variable. So it's one variable, it's net revaluation, that's what you use. But basically, it could be negative or positive, and it comes from both sides of the balance sheet. And so, for example, negative revaluation could be, for example, decrease in the ruble equivalent of assets, or increase in the ruble equivalent of foreign denominated liabilities. And positive would be the reverse. One thing I should mention that well, basically this efficiency score analysis uses the costs of banks traditionally. And the costs are the flow variables. And this revaluation, it deals with the stock variables. Basically, you have a stock of foreign assets or foreign liabilities, and then boom, due to currency swing, it's revalued. So to me, it's a bit sort of apples and oranges, but maybe still you could maybe explain that, somehow motivate that this is not the case, and actually it would be a good thing to. So basically, like you described during your presentation, you said the revaluation is something which should be taken out, right? And I think you should motivate it more why this is the case. Actually, in this slide, I thought that revaluation may be not something as a nuisance, like you say, it's something to be taken out, but maybe something you could actually study specifically, something maybe you could focus. So, for example, just the case, just artificial example. So the bank correctly forecasts that the ruble will devalue and invests in foreign assets in order to get more, ruble value of it. But we know that by regulation, well, banks cannot just have foreign assets without foreign liabilities. There is certain regulation that foreign assets and foreign liabilities must be matched within certain limit. I don't know precisely those limits. I guess you should look at the regulatory documents. What's the margin? So how much of foreign assets should be matched with foreign liabilities. But it seems revaluation would occur if those are not exactly matched. So basically, bank is after the flow variables. Bank wants to earn income from these assets in foreign currency. Then it would have to pay some costs in foreign currency, which it has to assume as foreign liabilities. But then, because there is some mismatch, suppose it has more foreign assets than foreign liabilities, and due to ruble devaluation, it have positive reval. And I thought maybe banks strategically played that, and maybe you could study this if you wish. But you basically say it's some nuisance which should be taken out, which is also fine. But I thought you just maybe need to spend more time on clarifying what that is. Okay, that's all about revaluation stuff, and now I move to the second contribution, and I will be brief here. So I think this result is quite sort of maybe puzzling, if you wish, but it for sure draws the attention that foreign banks are less efficient. And I thought maybe if you experiment with these regressions where you determine the efficiency scores, maybe if you drop some variables or add some variables, those efficiency scores maybe will go up for foreign banks, and maybe it somehow will explain. You told in your presentation, it's not in your paper, at least in the version I got, that it's due that foreign banks are new, and those that are well established, they're very efficient. I think you definitely should spend more time in your paper explaining this, because this is the most important takeaway for economists from your paper. And that's quite controversial statement, so you need to back it up very solidly. So if you like your story that's due to new banks, that's great if that's the case. That old foreign banks are extremely efficient, but the whole result is driven by a large crowd of new foreign banks, and yeah, then it's fine. And then again, like I mentioned in the first slide, that it appears that this revaluation story does not explain the differences in efficiency. So these stories are in parallel. So maybe you could have separate papers. I don't know. One is sort of refinement and methodology, another is about efficiency of foreign banks. But at this point, they are not really connected. But maybe if you experiment more with these different determinants of efficiency scores, maybe you will see that this revaluation really matters. And foreign banks really maybe do more of this revaluation than Russian domestic banks. Yes, so it would be nice to connect that. And last slide. Thank you, Masha. It's the real last slide. Your empirical specification, when you study this, when you put your efficiency scores on the left-hand side and these 4 groups of banks on the right-hand side and a bunch of controls, you say you use 2-stage GMM with instruments, endogenous, lagged endogenous variables as instruments. I couldn't quite get from the text. Normally, I think in the panel data context, we use this dynamic Arellano bond, but I understand you don't use that. So it's not clear to me why would you use that GMM, maybe just standard panel data technique with fixed effects of some sort would work. And I thought even in that you could have time fixed effects, just in some way to take into account time effects. Then you in the robustness check, you redo everything using the Tobit model, and you argue that because efficiency scores are bound by 0 and 100. And I don't think it's really a good example of Tobit model application, because Tobit model is censored regression. So when we have some distribution of the variable, and then we know that it's censored, then we would use Tobit. But the fact that this variable has certain limits is not necessarily make it. Everything in this world has some, well, not everything. Like people's height has a limit, right? Or weight of the car has a limit, right? So we still use OLS, not Tobit. But maybe if you draw a density function and indeed it's censored, some sort of bell shape and then censored, then you maybe should use Tobit. Otherwise, I don't see the reason why I would use Tobit. Okay, thank you. But very elaborate paper, a lot of things done, a lot of work. So I really liked it, and I think if you just focus more on main contributions, that would be great.
Thank you so much. So let's collect the questions. Yeah, Kun?
My question would be, I like the revaluation story, but I would like to see to what extent it's a story about foreign financing. So my idea would be that on average, Russian banking sector, this revaluation thing is driven by having more foreign liabilities than foreign assets. So on net terms, the Russian banking sector is borrowing from the rest of the world. So if you have a negative revaluation shock, what it basically means is that there's an exchange rate shock in the Russian ruble, or there's a certain stock problem and you can't refinance, something like this. So is it possible to split off or look at these banks? So now you have the net revaluation, but what kind of revaluation is it? Is it the bank that's actually investing in dollar assets, or is it the bank that is massively in foreign financing? These are very different banks. And if it's the foreign financing, so I still like the result, but still have to be cautious, I think, because of course, if it is about foreign financing, what is this bank doing? It is funding itself abroad because it is cheaper. And then if things go wrong, and there's a financial crisis, and the exchange rate shoots up, then once they have a cost. But what you're basically saying is, the positive side, the lower interest rates, I'm going to take in my cost efficiency, but the downside, if things go wrong, I'm going to take out. You see, and that's tricky, because in a way, if it's about foreign financing and efficiency, why, and I as a bank take a risk, I take foreign financing, why should I only look at the benefit of the foreign financing and not the cost? So this is a tricky thing. So I like the insight that revaluations drive the whole thing, but still, should it always be not part of efficiency? So I think you have to argue this, and maybe split off which kind of revaluation there are. There's two types. And in that sense, I think I would also look at, so you had this you showed this table, and it's also in the paper where you look at loans to assets. But if the story is about foreign financing, I would do it with deposits to assets. And banks that had very few deposits to assets and actually borrow from foreign banks, there you see the big results. And banks that have a lot of deposits that fit locally and just have some investment dollars, that should be a very different way. So I would not look to the loans to assets, but to the deposits to assets. I think we should action there. But I like it very much.
Any questions or comments? If you wish, you will respond to some comments.
Yeah, okay. Oh, thank you for your comments. I found it very, very helpful. So, but I should clarify what do we understand when we say revaluations. Maybe it was misleading. Well, a bank might have assets and liabilities denominated in foreign currency, okay? Both sides of the balance. These are, I would say, foreign currency loans, foreign currency deposits. They are reported in balance sheets. But the resulting income or losses from these foreign currency denominated assets and liabilities, they are reported in profit and loss accounts, and they are caused only by the movements of Russian ruble. Russian ruble is very unstable currency, as we know, like other dollarized commodity countries have a lot of currency instability during the last years, last 20 years, I would say. So
at that time it was kind of fixed, so it was quite stable, except for 2008 crisis. It was managed back.
2008, yeah.
Managed back.
Yeah, and you can see it from one of my graphs during the presentation. So what I actually want to say that we estimate only cost efficiency, and we try to refine our understanding of costs. So we look at the structure of both sides of profit loss accounts and income and costs, and we saw that these revaluations reported in these costs and income at both sides, they are about from 10% at different banks to 90% at both balance. So their net effect, net revaluations as a percentage of total assets is about 0.1%. So their share might reach up to 80% of total cost, but their net effect is only 0.1%. Despite of that, interest income as a share of total income might be only about 10% or 15%, not 80% like revaluations as a share of total cost. But net interest income as a share of total income, or better to say as a ratio to total assets, is about 3.5%, 2.5%. So their net effect is much more higher. So if these revaluations are caused by ruble instability, not by managerial efforts, why should we stay this position inside costs? if we want to estimate sources of operating efficiency, operating cost efficiency, it is something that is inside the managerial control. No managers can affect ruble movements in our country.
Why not?
But
If you get any foreign exchange contracts, if you
No,
get some
you see-
sort of derivative that
Well,
you
it's
control
a
hedging.
different topic to estimate how
But
how-
you said
how-
it's
how
impossible.
No, wait a minute.
how systemic could this be?
Look,
No?
you have 1,000 banks. Exchange rate is the same for everybody. So all of them are affected the same way. And now you just said that
No.
for some
not
it's
the
zero,
same
for
way.
some it's
They have
90%.
different
So
business
it's a very
strategies.
big cross-section heterogeneity. It means it's very different decisions of banks, how they expose. Right?
That's my point, risk-taking by the manager.
So
That's my point. There is
exchange
one
rate
real
is the same
decision.
for everybody. The exposure is different. And then the fact that it's zero in aggregate, like you say, if you average across all the banks, it's basically zero. It confirms the point that its regulation is that you should have pretty matched assets and liabilities. So on average, they're matched, and that's why net effect for the whole banking system is zero. But some banks on some occasion have more exposure and less, and that's what you capture. And that's interesting.
No, something else is zero. I think what you're talking about is what in Russian they call the open foreign exchange position. That is close to zero because the limits of foreign exchange position are small. CBR does control that. Now what happens is that essentially for cost efficiency analysis, you look at the cost side, at the other side of the 102 form, okay, at the costs. And in the cost, within the gross costs, the significance of negative revals. In this case, we are talking only about negative revals. So we don't care about
Net.
the positive results coming from the regulation of assets, because those can also be hard currency. A bank may have a perfectly square foreign exchange position. Unlike your suggestion that this difference only comes from the one bank goes long in dollars. What we are describing has nothing to do with that.
Okay.
The fact is the bank may have a perfectly square foreign exchange position, but let's say there will still be revals which will go to its P&L account. Now the significance of those varies, as Michael showed. This histogram can be from zero. Some banks have 70%. The gross costs consist of 70% of revals. That is never a zero. The average significance of revals in the gross costs of Russian banks is never zero. It's much higher. And that's why, see, the fact that some banks do finance in hard currency, that's another, but after all, it's not a managerial kind of conscientious decision making. The foreign subs do get financing from their head offices, from their parent companies, so, that's how they were born, so it's not their merit. So what we are trying to do, trying to neutralize the impact of this factor. That's the whole thing. Yeah? And then what remains is to a much greater extent the result of the conscious decision making by the management. That's the point.
Analyzing cost efficiency, not net.
Exactly.
So you only look at negative revals.
Yeah.
You don't look at
Precisely.
net
Analyze
revals,
all
only
the
negative.
But that's how people calculate cost efficiency. How else?
Yeah.
They take the gross costs and they
Okay,
see.
now-
We have to stop here.